All right. Hope everyone's having a good time. I'm going to record the overview, the chapter outline for chapter 5 that has to do with capital assets. And so I think there's a few slides here, but we're going to flip through them fairly quickly. The learning objectives here. Oops, let me turn back to the screen draw. So anyway, our objectives for this chapter are describing the nature and characteristics of general capital assets. Okay, so these general capital assets, it's important to understand. Okay, within a local government, they have roads and street lights and parks and fire halls and police stations. All these things are considered general capital assets. The distinction that you need to have in your mind is if there's assets that are part of an enterprise, like an activity that is intended to be self-supporting, like a utility of some sort, then those assets are not general capital assets. Those are enterprise fund assets, and they'll be accounted for on a full accrual basis. Okay? So anyway, you have to make that distinction. All right? And we'll talk later about this options for recording depreciation for general capital assets. So it doesn't apply again to these enterprise fund assets. Another thing here is the acquisition, maintenance, depreciation, and disposition. The impairment part of this, it's important to be aware of. It's just like for commercial operations. If you have a permanent material impairment in an asset, you write it down, and there's specific guidance for that. But we're not going to. I'm not expecting you to master that material. Mainly the acquisition. Anything it takes to get ready to use. Typically, governments self-construct assets or use contractors to help self-construct assets. So you can have cost allocations of labor and so forth. It's everything that's related to the construction of the asset or acquiring the asset is capitalized, just like it is in for-profit enterprises. Okay, one issue here is maintenance versus betterments, and so the same issue comes up if you make an improvement, if you expenditure for an existing capital asset, is it maintenance or is it capitalized? And so typically, if it results in improved quality or output or whatever, you would capitalize that accordingly, either reducing accumulated depreciation and or just adding the capital value. The next point here is the number 3, the purpose and characteristics of typical financing sources. So typically in Alaska, capital projects are funded through debt issues and are in conjunction with state capital project funding. So you can get external funding from state or federal sources to acquire or build capital assets. All right, and so we'll see. It's important to understand how the funding works because, for one, you're going to record revenues or resources that are from debt issues in the capital project fund, and it's important you do that correctly, and we'll see how that works. And then if you don't need all the money, what happens to the leftovers? And so that depends on if it's grant funded. That's typically a special revenue that's restricted for purpose, so you can't reallocate and spend on something else. But if the project costs more than those restricted funds, you're usually okay. You get to reallocate the funds you didn't need through the debt issue or the transfer from other funds back. Okay. Moving on. Finally, journal entries. So we'll go through the journal entries for a typical capital project at both the fund level. So again, we set up buckets, these individual fund entities, to account for all the costs. And then on government activities, of course, we don't have separate funds, but basically they're very similar entries. Instead of expenditures, though, for a project that would be occurring in the government funds, capital project fund, you're going to have construction in progress, or you'll have assets that are acquired, and that would be the debit instead of expenditures. And when like if you're building a building or facility, when it's completed, the construction in progress will be converted into the fixed asset. Okay, so let's take a look here. Capital assets, as I mentioned, include all these things that are part of the general government. And notice here, works of art and historical treasures. So Detroit actually, was in bankruptcy, and one of the big assets they had was this art museum that has some very rare and highly collectible paintings. And so it's not unusual for governments to hold these items in museums or libraries. And so there's specialized accounting for that, but we won't worry too much about the details there. Mainly it's how do we acquire capital assets and what's the accounting for that process. All right, and they say here commonly finance the issuance of long-term debt, which will be serviced by tax revenues. So the next chapter that we talk about will be debt service, and these two kind of go hand in hand because, like I said, oftentimes you issue debt for the purpose of building an asset, a parking garage or something, a fire station, and you'll use that proceeds to cover the majority of the cost or a substantial portion of the cost. Okay. So now the accounting for general capital assets. Okay, so again, in the government fund, it's going to be outlay expenditures, and we typically have a bucket. So it could be a special revenue, or in the general fund, they could buy equipment that's related to those asset or those functions. Typically, though, for major stuff, you're going to have a capital project fund that'll keep track of those costs. And then government activities, once it's acquired, it'll show up as an asset, and you'll have a depreciation that you'll recognize in association with that asset over its useful life or economic life. In the government funds, remember, you're really just tracking current year expenditures, and so whether it's police cruisers or a new fire station or whatever, once the expenditures are done, it disappears from those financial statements. Okay, so here's kind of some of the accounting. Recorded historical cost, typically capitalized in government activities, depreciated and expense reported in government activities. And we'll talk about that issue later, but in the context of some of the problems. So where does depreciation actually show up? Because if you think of the statement of activities, okay, the income statement for government activities or government-wide, it has expenses, total expenses by function. So depreciation is actually allocated to all those functional areas. So the public safety will have the depreciation of the police cruisers and fire trucks and related equipment and the fire hall and the police station, whatever. It'll all be included in that total expense figure that's reported in the statement of activities. The indirect depreciation, or depreciation is related to indirect assets or assets that are shared common good, are included in just general government. Okay. Required disclosures, this being the footnote. So you typically have a footnote that reconciles the beginning to ending capital assets, so additions, disposals, and so forth. All right. Then we got land. We've talked about those. It's just like, I haven't talked about it, but it's just like the case for commercial accounting. It doesn't wear out. You don't depreciate it. Building and improvements includes everything that you put into it, all the components for heating, ventilation, so forth, fire. This is typically, how it happens. You use an outside contractor or a combination of contractors and self-constructed. Sometimes you get it donated and see it counts as a contribution revenue based on its appraisal or fair market value. People do that. We've got machinery and equipment. It could be donated as well. Construction work in progress. This is the government activities account where you accumulate expenditures to acquire an asset or construct an asset. And once it's done, it's reclassified, as it's shown down here, into the appropriate asset category. All right, infrastructure assets. So these are a set of the general capital assets that has to do with like parking lots, sidewalks, a storm drainage system, so forth. Typically, they're depreciated over like a 50-year life, or whatever the customary life is. But there's an option here called the modified approach, and this basically says if you're maintaining your assets, your infrastructure assets, like you're patching the holes in the roadways and the parking lots, and you're resealing these things regularly, and generally maintaining the condition of the assets, it's like a double hit to incur those costs, those maintenance costs, and a depreciation charge when you're substantially extending the life of those assets. So as long as you meet the requirements of the modified approach, you're not required, the government's not required to recognize depreciation expense annually. Once it fails to do that for a class of assets, then it can't go back. Basically, when you have deferred maintenance builds up, you're in a situation where you have to go back to the depreciation method. But this is the requirements. So you basically do an inventory of all your eligible assets, assess the condition at that time, and then just annually maintain them, and that's it. Okay. And this just talks about documentation, includes the condition assessments and so forth. Okay, and then here we've got leases. Oh, I skipped over this intangible. So one of the intangibles that a city might own would be rights to something, like water rights, for example, in an area. Could be intellectual property, and so they would be treated just like capital assets, only they have, of course, you can't touch them. Okay, and we do have leases, and the same rules apply here that you have. Actually, all leases are capitalized now in financial accounting. They got tired of the games that were used to structure those as off-balance sheet financing, and so the same thing is happening with GASB. Everything will be capitalized. It's kind of interesting, though. In governmental accounting, leasing is common mainly as a budget workaround. It's sometimes difficult to get approval, budgetary authority to make a large expenditure, like to acquire a sizable asset, for example. It's much easier to just enter a rental agreement, an operating or even a capital lease, and basically buy it over time, even if you pay a premium. It's just one of the artifacts of of having a budget hurdle to get through, and so it's real common. As are these service agreements that are discussed later in the chapter. But anyway, if it's transfers ownership, has a bargain purchase price, the lease term is for 75% or more of the useful life, or the lease payments exceed 90%. You capitalize it, and otherwise it's just a rental agreement, and you expense it. The the interesting thing about the capitalized leases is the accounting treatment in governmental funds. You basically show it as a debt issue, so you for the fair value of the lease payments that you're committing to, well, that will show up as an other financing source, just like if you'd issued debt. And so it's consistent with that accounting treatment. And then we dispose of assets. Okay, so now remember, in the governmental funds, there's no asset that has to be removed because they're all expense or expenditures in the year they're acquired. So basically, you're recording the cash, and you'll have a revenue, or not revenue, but a other financing source from the sale of a fixed asset. In the government-wide side, you're going to have the typical asset, and it'll be a combination of, cumulative depreciation and a gain or loss if there is any. Okay, and we talked briefly about impairments, and I'm just going to skip over that. These service concession agreements, this is where you decide, for some reason, the government decides that it's not going to operate something, it's going to contract it out. So maybe the swimming pool, for example. Colleges and universities have recently entered into service agreements for parking, where someone will go through and they'll manage the parking lots that they have. So they'll make sure that they're maintained often. They issue tickets for users that aren't paying the meters or have a permit to park there and so forth. Dormitories, they even construct assets for use by the university in exchange for being able to operate them. And so the big difference here is that you're going to incur, the fees have to cover the cost of maintaining that, plus profit and taxes that would be paid on that. So typically it's a way to spin off expenditures to a third party. Sometimes it can be more efficient, but oftentimes it's because for budgetary reasons. Okay, and let's run through. There's a couple examples. So here's the case where we issue. We're going to build a fire station, and the journal entries that would be associated with that. So we're going to enter a short-term working capital arrangement to provide funding. Here's an encumbrance. So encumbrances can be used, and you'll see examples in the book where they're used for some and not all of them. So that would be basically a budget, in many senses. So if a capital project is going to have a budget, it makes sense to use encumbrances so that you're able to stay within the budgetary authority that's been provided. Capital project. Okay, so here's where revenues are received from an outside source, and you can see down here it's classified as capital grants in the government activity. So we receive funding, as this is from the chapter, we receive funding from an outside source that's restricted for the fire station project, and you recognize as a revenue in the capital project fund. Okay, and then these are just expenditures as you go through time. So we've got interest on the short-term note when it's satisfied. Here's the sale of a bond for $1.2 million. So the interesting thing about these bonds is they're never issued at a discount, so the rates are always set. So you're going to be in a premium situation, and that premium is not put in the capital projects fund. It's recorded into the debt service fund, and we'll see more of this in the next chapter. They'll actually combine problems where you have debt issued in conjunction with the capital project fund and the servicing of that debt later. But the intuition is that premium is an adjustment on the interest rate and affects the principal, the amount borrowed, and so it goes to the debt service fund. And so you have to be sure that you set the principal amount high enough so that you have adequate funds to complete the project. And this just goes through and shows, okay, here's a construction billing in 10B, and we've reversed the encumbrances, and we set up expenditures, construction expenditures in the capital projects fund. And in government activities, we have construction work in progress, and then additional billings. So we reverse the rest of the encumbrance, and we record the additional expenditures of 510. And then we've got government activities. That 510 is construction work in progress. And then when it's all completed, the contracts payable are actually a check is issued for that amount. And then this slide shows the closing entries. They see the debits to revenues and that closing entries, and the fund balance that's left is restricted. So it shows that there's funds that are restricted only for capital projects. They may have to be sent back to the grantor because part of that was grant funds, but it seems like the project has enough expenses that those funds could be reallocated to some other project. Capital projects fund, we're closing those entries out into, let's see, fund balance, transfer, and then government activities. So the only entry here is we take our construction work in process and we credit that and move the debits, the total cost, into a buildings account. Okay, and this talks about the premium and interest I mentioned. Retained percentage is the last topic here. So it's common for a government to collect a fee or hold back a fee for against contract billings to ensure performance at the end. So you typically will hold back up to 10%, and that usually represents profit to the contractor until the project is done. So you get a billing, you record the full amount of the billing as an expenditure or construction in progress. But when you actually cut the check, you're withholding the retained percentage. And then at the end, after a final inspection is done and all the issues that are identified are taken care of by the contractor, only then is the final retainage paid out. And so we'll see problems get practice with that. And I think that this is it. So we're done with this part.